Good afternoon. Welcome to the Monetary Policy Stance and Monetary Policy Report press briefing. Let us welcome the following BSP resource speakers: Monetary Board Chairman and Bangko Sentral ng Pilipinas Governor Benjamin E. Diokno, Deputy Governor Francisco G. Daquila Jr. of the Monetary and Economic Sector, and Managing Director Zeno Ronald R. Abenoja of the Department of Economic Research. Governor Diokno will now deliver the statement on the monetary policy decision.
At its meeting on monetary policy today, the Monetary Board decided to raise the interest rate on the BSP's overnight reverse repurchase facility by 25 basis points, or to 2.25%, effective Friday, 20 May 2022. Accordingly, the interest rates on the overnight deposit and lending facilities were raised to 1.75% and 2.75% respectively. At the same time, the Monetary Board noted that the strong rebound in domestic economic activity and labor market conditions during the first quarter of 2022 provides scope for the BSP to continue rolling back its pandemic-induced interventions, consistent with its exit strategy from monetary accommodation. With the provisional advances to the national government reduced from 540 billion pesos in 2020 and 2021 to only 300 billion pesos in January 2022, the national government will fully settle these loans tomorrow, 20 May 2022, ahead of the maturity schedule of 11 June 2022. Moreover, given the ample liquidity, a gradual recovery in credit activity, and stable financial market conditions, the Monetary Board has decided to reconfigure the BSP's government securities purchasing window from a crisis intervention measure into a regular liquidity facility under the interest rate corridor framework. As part of the BSP's standard monetary operations toolkit for injecting liquidity into the financial market, the recalibrated government securities purchasing window shall enhance the BSP's ability to manage domestic liquidity conditions and ensure the sustainability of its balance sheet. In deciding to raise the policy interest rate, the Monetary Board noted that the latest baseline forecasts have further shifted higher since the previous monetary policy meeting in March, indicating that elevated inflation pressures could persist over the policy horizon. Average inflation is likely to breach the upper end of the 2 to 4% target range in 2022 at 4.6%, while the forecast for 2023 has edged closer to the upper end of the target band at 3.9%. The balance of risk to the inflation outlook now leans toward the upside for both 2022 and 2023, with upside pressures emanating from the potential impact of higher oil prices, including on transport fares, as well as the continued shortage in domestic pork and fish supply. Meanwhile, downside risks are linked mainly to the potential impact of a weaker than expected global economic recovery amid the lingering threat of COVID-19 infections, heightened geopolitical tensions, and a tightening of global financial conditions. The Monetary Board also observed the emergence of second-round effects, including the higher than expected adjustment in minimum wages in some regions. Inflation expectations have likewise risen, highlighting the risk posed by sustained pressures on future wages and price outcomes. Given these considerations, the Monetary Board believes that a timely increase in the BSP's policy interest rate will help arrest further second-round effects and temper the build-up in inflation expectations. The Monetary Board likewise reiterates its support for the sustained implementation of non-monetary interventions to mitigate the impact of persistent supply-side factors on inflation, particularly food supply and prices. On balance, persistent inflationary pressures point to the need for prompt monetary action to anchor inflation expectations. As the economic recovery continues to gain traction, the BSP shall proceed with its plans for the continued gradual withdrawal of its extraordinary liquidity interventions and the start of the normalization of its monetary policy settings. Looking ahead, the pace and timing of further monetary policy actions by the BSP shall be guided by data outcomes in keeping with BSP's price and financial stability objectives. That's the end of my statement.
Thank you very much, Governor. At this point, we would like to request Managing Director Abenoja to share with us the May 2022 Monetary Policy Report.
Thank you, Alicia. Good afternoon to our stakeholders joining this press conference. I will have a short presentation this afternoon to provide a summary of the key considerations that form the basis of the Monetary Board's latest policy decision. The more detailed discussion of these points will also be published in the Monetary Policy Report for May 2022, which will be released tomorrow in the BSP website. Just for recall, beginning this year, we will be publishing the Monetary Policy Report, or MPR, 4 times a year. And this will be consistent with the availability of major economic data releases, such as the quarterly national income accounts. The MPR replaces the quarterly inflation report, and the May issue that we will be releasing tomorrow will be the second publication for this year. Now, turning over to some of the highlights of the key considerations of the monetary policy decision today, the Monetary Board members look into the following key issues. First, the latest baseline forecast are already indicating that inflation could settle above the government's target range of 3% plus minus 1 percentage point at 4.6% in 2022 and 3.7% during the last monetary policy report. It can be recalled that in February, the 2022 forecast for average inflation was at 3.7%. It was increased to 4.1% in the last March monetary policy meeting and is now at 4.6% average inflation for 2022. For 2023, it is at 3.9%, closer to the upper end of the target range for next year. Now, the inflation forecast for 2022 were adjusted upward, and this is due primarily to the following factors. First, the higher assumptions for crude oil and non-oil prices. For the crude oil prices, it is seen to average at about a little over $100 per barrel, compared to the $83.3 per barrel that was assumed last February as contained in the February Monetary Policy Report. For 2023, the crude oil price average assumption was also increased from about $76 per barrel in the February 2022 Monetary Policy Report to almost $90 per barrel in the May Monetary Policy Report. The prices for non-oil, global non-oil prices were also upgraded in this round of projections to recognize the impact of the Russia-Ukraine crisis on global commodity prices. The 2022 projections also incorporate the faster GDP growth outlook for the first quarter of this year, the higher than expected inflation outturns in March and April, as well as the depreciation of the peso. It should also be emphasized that the forecast also takes into account the increase in the minimum wage in the NCR, the acceleration of the increase in Fed funds rate in the US, as well as the slowdown in the expansion of world GDP because of the tightening of global financial conditions and the impact of the Russia-Ukraine conflict, as also contained in the IMF WEO report. Now, the risk to inflation outlook for 2022 and 2023 are tilted towards the upside. This is depicted in the updated fund chart, which shows that it is more positively skewed towards the upside. This reflecting the increased likelihood and higher magnitude of the upside risk to the inflation outlook. At the same time, if we look at the inflation path, the darkest band or the black line at the middle of the fund chart, it shows that inflation is expected to accelerate in the near term. The forecast path indicates that inflation could remain above the target range until the first quarter of 2023. It could peak, average inflation could peak in the second quarter of this year at slightly above 5%, hovering at around 5% for most of the second half of this year before decelerating in 2023 and going back to target by about second quarter of next year. And this will be facilitated by negative base effects as well as possible tapering of global oil and non-oil prices next year. So what constitutes the upside risk to inflation moving forward? The potential impact of further increases in global non-oil prices, the continued shortage in domestic pork supply, higher fish prices, and possible jeepney fare hikes due to higher oil prices are the major risks to the inflation over the policy horizon. Meanwhile, potential impact of a weaker than expected global recovery, as well as possible reimposition of quarantine measures due to possible resurgence in COVID-19 cases are the main sources of downside risks. At the same time, the volatility of global oil prices continue to present a risk to the inflation outlook. To determine the impact on the inflation forecast for 2022 to 2023, we show here some of the results of possible inflation outturns under different world oil price scenarios, particularly within the range of $100 to $200 per barrel. And what the results show is that for 2022, at a range of $100, it will already be at above the target. And for 2023, if the buy crude oil prices continue to average at $100 per barrel for the rest of the year until 2023, that could also push inflation just on the upper end of the target at around 4%. It should be noted that these oil price scenarios consider only direct effects and do not incorporate any potential second-round effects on other key items like transport fares, broader food prices, or wage increases. Now, if you look at the inflation outcomes, particularly for March and April, they would show that inflation pressures in the past 2 months have been mainly due to a certain set of CPI items, particularly transport, energy, and some food items. Uh, While the inflation pressures remain limited in the recent inflation outturns, we now see signs of second-round effects emerging, given the rising inflation expectations and the wage hikes that we have observed recently. Results of the BSP's survey of private sector economists for May 2022 showed higher mean inflation forecast for 2022 at 4.6%. Similarly, the mean inflation forecast also increased to 3.6% for 2023. At the same time, we also took into account the recent announcement from the Department of Labor and Employment last March 14, 2022, that the regional tripartite wage and productivity boards has raised the daily minimum wage of non-agricultural workers in the NCR by 33 pesos to 570 pesos per day. The minimum wage for NCR, if can be recalled, remained unchanged since November 2018. As we see the emergence of second-round effects, the Monetary Board also took note that economic recovery is seen to continue to gain traction. Domestic economic activity is projected to return to its pre-pandemic level by the middle of 2022. Domestic growth is seen to remain robust in the succeeding quarters in view of the implementation of reforms to boost investment and credit activities, as well as the looser mobility restrictions amid continued widespread deployment of vaccines and booster shots. The eventual reopening of the global economy as restrictions ease and the labor market conditions improving further are seen to bolster domestic recovery through increased exports and remittances moving forward. Looking at the output gap, it is now estimated to have closed in the first quarter of this year and seen to remain broadly neutral during the rest of the year as the economic recovery continues to gain traction. Potential output is expected to increase at pace with actual output amid the continued reopening of the economy, improvements in employment conditions, as well as continued growth in external demand moving forward. The strong rebound in domestic economic activity and improvement in labor conditions in recent months provide scope for BSP to continue to roll back the pandemic-induced interventions as contained under the BSP's exit strategy. The exit strategy has 5 main components. The first component involves the recalibration of the BSP's monetary operations through the gradual absorption of excess liquidity to ensure that the desired monetary policy stance is transmitted to the economy through short-term interest rates. The exit from these pandemic-related measures have in fact started when we have gradually recalibrated the volume offerings in the term deposit facility as well as the BSP securities facility to reflect prevailing liquidity conditions. These operations have effectively guided short-term interest rates closer to the policy rate. A second component involves the pursuit of BSP's interest rate corridor roadmap to ensure effective monetary policy implementation. A third component involves the unwinding of the extraordinary measures as well as other regulatory relief measures as mentioned or as contained in the statement of the governor earlier. And then a fourth component comprises raising the policy interest rates when prospects for economic recovery are firm. And then finally, the fifth component includes the preparation for future crises. In deciding to increase the policy interest rates, the following items were considered. First, latest baseline forecasts have shifted higher from the previous policy meeting, and the balance of risk now leans towards the upside for both years, 2022 and 2023. The BSP also recognizes the emergence of second-round effects, both in terms of inflation expectations and granting of minimum wage hikes. And also, the domestic economy has gained stronger traction with the easing of mobility restrictions. And in fact, the economy is projected to return to its pre-pandemic level within the first half of the year. With improved economic and labor conditions, this provides scope for the BSP to roll back its pandemic-induced interventions. And today, the governor has announced that the provisional advances to the national government will be fully settled by tomorrow, May 2022, and that the government securities purchasing window will be recalibrated from a crisis intervention facility into a regular liquidity facility under the IRC framework. I stop here the briefing. Thank you very much for your attention.
Thank you, MD Abinoja. We will now proceed to questions that have been sent to us by the press as well as market analysts. For any additional questions or clarifications, you may send them through our live Facebook broadcast or send us a message through text, Viber, or Messenger. We have our first question from Lee Chipongyan of Manila Bulletin. She asks, the BSP noted in March that inflation will not likely exceed 5% this year. Are you still saying this?
Thanks, Lee, for that question. The BSP noted that the BSP's latest baseline inflation forecast shifted higher from 4.3% to 4.6% for 2022, and from 3.6% to 3.9% for 2023. These were driven by the higher than expected inflation outturns in March and April, the continued volatility in global oil and non-oil prices, the higher than assumed minimum wage increase for NCR in Region 6, and the stronger domestic growth outlook. Now, these updated forecasts embody a generally higher inflation path over the near term. Given recent developments, inflation could likely exceed 5% in the next few months. However, barring any further adverse shocks, we also expect inflation to slow down, heading closer eventually towards 2023 and revert to within the target band by the middle of that year as the effects of the global commodity price shocks dissipate.
Thank you, Governor. Our next question, also from Lee Chipongyan. Some analysts think that second round effects have started to creep in and will be felt in the second quarter of this year. Do you agree with this assessment?
Well, the BSP recognizes the emergence of second round effects, such as the increase in inflation expectations for 2022 to 2024 based on our May survey round. At the same time, the recent approval of wage hikes in the National Capital Region and Western Visayas leaves the door open for increases in other regions as well, particularly since wage petitions have been deferred since 2020 owing to the disruptions caused by the pandemic. We also monitor the possibility of transport fare adjustments as transport groups continue to pursue their petitions on the back of the persistently high oil prices. The protracted conflict between Russia and Ukraine certainly adds to these pressures.
Thank you, Governor. Our next set of questions are the following. From Michael Ricafort, Chief Economist at RCBC. How many basis points would be the impact of the wage rate hikes and transport fare hikes on headline inflation? Have the wage hikes and possible transport fare hikes been incorporated in the inflation estimates?
As mentioned earlier, the baseline inflation forecast for 2022 and 2023 are at 4.6% and 3.9% respectively, already incorporate the impact of recently announced wage rate hikes. The regional tripartite wage and productivity boards for NCR approved to increase the daily minimum wage of non-agricultural workers by 33 pesos to 570 pesos, which remained unchanged since November 2018. Meanwhile, the impact of transport fare hike was included as upside risk to the inflation outlook, along with the potential impact of higher global non-oil prices, the continued shortage in domestic pork supply, and higher fish prices. On the other hand, the potential impact of a weaker than expected global recovery, as well as the reimposition of quarantine measures domestically due to possible resurgence of COVID-19 cases, are the main sources of downside risk. Overall, the risks to the inflation outlook appear to be tilted on the upside for 2022 and for 2023.
Thank you, Governor. The next question comes from Wendy Noble of Business World. She asks, how has the BSP considered the latest 50 basis points hike by the Fed and the outlined plan to reduce its balance sheet? At the same time, central banks in the region, like Malaysia and Singapore, have also tightened policy rates due to rising inflation. How do you think the Fed's move will impact the Philippine economy at a time when inflation has already breached target? How will these developments affect monetary policy moving forward?
Well, the recent policy tightening by the US Fed was anticipated as the guidance provided by the Fed prior to their latest policy decision reduced the uncertainty and could help avert a repeat of the taper tantrum in 2013. This underscores the value of carefully communicated forward guidance, especially on matters of quantitative tightening. The Fed's actions, which were based on their forward guidance, were part of our discussions in the Monetary Board policy meeting. The Fed funds future path as of 19 May 2022 shifted upwards compared to the previous forecast rounds. Economists now expect the Fed to raise the benchmark policy rate by a total of 275 basis points in 2022, bringing the Fed funds target to an upper limit of 3%. The recent 50 basis points hike was widely expected, while the pronouncement of a reduction in the Fed's balance sheet by $95 billion a month starting in June 1st provided further clarity to their plans. At this point, the BSP remains well equipped in handling policy risk and external balances. In the event of tighter financial market conditions and exchange rate pressures, the BSP's first line of defense includes maintaining a flexible exchange rate, as well as relying on its ample levels of foreign exchange reserves to stabilize the exchange rate and contain wild swings in the financial market. The BSP is also prepared to use its dollar liquidity enhancing measures, complemented by calibration of macroprudential measures and access to international swap lines, among others, to address the impact of large portfolio adjustments by global investors. Moreover, resilient structural flows from remittances, BPO earnings, and the anticipated rebound in export revenues should also provide support to the Philippine peso despite some depreciation pressures. We would like to reiterate that future monetary policy decisions will continue to be data-driven and anchored on evolving domestic developments to avoid unintended consequences associated with prolonged easy monetary conditions. We also like to emphasize that although inflation is projected to accelerate further over the near term, the BSP projects average inflation to revert within target in 2023 as global and domestic supply pressures ease.
Thank you, Governor. Next question from Eileen Mancias of Abante Billionario. What do you expect to achieve with today's monetary policy action?
Well, a timely increase in the BSP's policy interest rate will help temper build up in inflation expectations. The BSP likewise reiterates its support for the sustained implementation of non-monetary interventions to mitigate the impact of persistent supply-side factors on inflation. Moreover, the strong rebound in domestic activity and labor market conditions in Q1 2022 also provides scope for the BSP to continue rolling back its pandemic-induced interventions.
Thank you, Governor. From Sonia Zhu, associate economist at Moody's Analytics. She asks, we have seen inflation rise rapidly in 2018 with a corresponding rate hike to rein it in. Is the BSP prepared to hike rates more aggressively to ensure current inflation pressures are kept within the target band, either via multiple 25 basis points hikes, or should we expect fewer but sharper hikes by 50 basis points?
Thanks, Sonia, for that question. The pace and timing of further monetary policy actions by the BSP shall always be guided by data. We are only just starting the monetary policy tightening cycle, so we must weigh all future developments so as not to disrupt the growth momentum while preventing price pressures from becoming further entrenched. As always, the BSP stands ready to respond to domestic and external developments accordingly, in keeping with our price stability mandate.
Thank you, Governor. We have a question from Ian Sigaral of Philippine Star. He asks, can we get an update on the BSP's government bond holdings? What is the highest level that these bond holdings have reached since the pandemic began? Has the BSP started reducing these bond purchases? If yes, when did it start and what's the current level of the government bond holdings now?
Well, at the height of the pandemic, the BSP would be holding something like around more than 40% of the government securities in the secondary market, more than 40%. It's now down to less than 3%. I think more like 2%. That's how we have revised our exposure to the government securities market.
Thank you, Governor. We have additional questions from our media friends as well as from market analysts. We have this question from Eileen Mancias of Abante Billionario. Will today's monetary policy action impact the GDP growth rate?
We have to review or recalibrate, but the same question was asked during the monetary policy meeting, and the answer is that very little, but we continue to evaluate the situation.
Thank you, Governor. The next question comes from Sig Alegado of Bloomberg News. Good afternoon. The policy statement says that the purchasing window for GS in the secondary market will be reconfigured into a regular liquidity facility under the IRC. May you please expound on that? What would this facility look like and how will it be integrated into the rate corridor program of the BSP? Thank you.
All right, may I call on DG Francis to answer that question?
Thank you, Governor. As was emphasized, in the press statement, as liquidity conditions continue to normalize, there's now ample space for the BSP to start recalibrating the GS window consistent with the exit strategy framework. The BSP also needs to convert the GS window into a more active operation wherein the BSP can determine the volume and tenor of GS that will be purchased from or sold to the secondary market. And reconfiguring it into a regular facility under the interest rate corridor framework will also strengthen the government securities window's effectiveness as a tool for liquidity provision or absorption and make the operation transparent, consistent with international practices, and also ensure the sustainability of the BSP's balance sheet. Thank you.
Thank you, DG Dakila, and thank you, Governor. The next question comes from Ms. Louise Lu of Morgan Stanley. She asks, I have two questions. First, where does BSP view the neutral interest rates to be, and what would cause the BSP to need to hike into restrictive territory? And second, can you also briefly discuss what your conditions would be going forward to hike in larger incremental steps?
Would you like to answer that, Francis?
Thank you, Governor. Again, our communication, instead of casting it in terms of the neutral policy rate, has always been cast in terms of the inflation outlook and how that relates to the inflation target. And that's so because it's clearer because it's in terms of observable variables. Again, as has been emphasized in the presentations and in the question and answer portion, all future monetary policy decisions, as has always been, will continue to be data-driven and anchored on evolving domestic developments. And it will be very carefully considered to avoid unintended consequences associated with both prolonged easy monetary conditions and also keeping in mind that we do not want the policy actions to be disruptive of the growth momentum of the economy. Thank you.
Thank you, Deputy Governor, and thank you, Governor. Next question comes from Euben Paracuelias, who is Chief Economist at Nomura. Thanks for the briefing. The currency has been relatively stable against the US dollar in the past month compared to regional peers, which have depreciated, like those in Malaysia, Indonesia, and Thailand. Does this imply some interventions in the foreign exchange market by the BSP? Is the currency a key channel for the BSP to contain inflation risks? What is the BSP's estimate of the pass-through?
Well, you're right. If you compare the Philippine peso with its regional peers, it also depreciated, but all currencies depreciated, and maybe we're right there, smack in the middle on the rate of depreciation. We continue to pursue a flexible exchange rate, and so we only enter the market if there's some extreme volatility, and that is harmful to our stable price stability objective.
Thank you, Governor. From Warren de Guzman of ANC, good afternoon. Did the Monetary Board decide on a rate hike today with the intent of continuing an orderly normalization of interest rates? Or is today's 25 basis points hike seen as sufficient to achieve the desired effect for the year?
I think I've made it very clear we're monetary policy, it will be data dependent. So we meet every other 6 weeks. So we look at the most recent information and most recent developments externally and domestically. And so we make our decision on the basis of the information, the most recent relevant information available to us.
Thank you, Governor. We just have a few minutes to go for the questions. Next is from Mr. Emmanuel J. Lopez of the Colegio de San Juan de Letran. He is the graduate school dean there. He asks, inflation is heavily supply driven. Don't you think that it will take a heavier toll on consumers?
Would you like to answer that, Francis?
Thank you, Governor. It's true that inflation has been driven by supply side factors. It can also be noted that the GDP out there for the first quarter is very strong, and the main driver of that growth is consumer expenditure, and that strength has come with the reopening of the economy. So the policy adjustment is very carefully measured, and the impact on consumption will really be quite small, and again, with further reopening of the economy, we can expect that consumption should be strong. Thank you.
Thank you, DG. We have our last question so far from Aileen Mancias of Abante Bilionario. Do you expect to increase the BSP's holdings of government securities when the new administration comes in? How would you gauge the comfort level of investors on the Philippines when the new administration comes in using the forward swaps as proxy?
Our holding of government securities does not depend on any administration, okay? So it will depend on the needs of the BSP to pursue its mandate.
Thank you, Governor. We have one additional question, this time from Nicolas Mapa of ING. He asks, previously, the growth objective appeared to be a major consideration for policy decisions. With GDP's resurgence, will there be more emphasis on inflation containment and re-anchoring of inflation expectations going further?
Well, we also did not expect the 8.3% growth in the first quarter because of the surge in the COVID cases in January, but we got 8.3. We expect Q2 GDP to be higher than Q1, and so we're already on our track to meeting our growth objective of 7 to 9%. So, but we continue to monitor the impact on, of course, on employment, which also is performing very well. We're fairly close to where we were before the crisis, and so we, of course, also continue to look at our inflation target because that's the primary concern of the BSP.
Thank you, Governor. If there are no more questions, we would like to thank everyone for their time and attention this afternoon, including those watching us live on our FB page. Also, we would like to thank our viewers and remind them that the Monetary Policy Report will be available on the BSP website tomorrow, Friday, May 20. Maraming salamat po and keep safe.